Good afternoon, everybody. I'm looking out my window. Andy, can you hear me out there? All right, I got the thumbs up from Andy, so it looks like we're good to go. Well, we're just getting going on this. I'm actually about a minute early, and we've already got, I think, the most people that we have ever had on these quarterly webinars. So apparently, what we're going to talk about today, everybody's looking forward to hearing more about. And while we're letting people sort of file in, because we're getting a lot more that are coming in right now, I think that this is fitting to start this one with a story. So it's a story that my father has told me for years and years and years, and it's actually one of my favorite stories that he's ever told me. And I can see my father's on here as well. I don't know if he knows this is one of my favorite stories, but like many people, when he was a younger man, he used to work construction, and did during summer when he was in college. And he would go to the construction site every morning, and he would see this older gentleman that was sitting on a park bench, and he would sit there for hours and just watch these guys build and watch these guys work. And he would sit there with a bag lunch and maybe a soda and just all day long. So finally, my dad, who those of you know is a very conversational guy, walks over to this gentleman and says, "Sir, I see you here every single day. What is it you're doing here?" And he said, "Young man, I like to watch things grow." So I think in the spirit of that, that's a good sort of segue into what we're going to talk about tonight. This one's going to be a little bit different than what we normally do. Those of you that are clients know that we do these quarterly webinars. We talk about things that I think are kind of interesting. We talk about things that you want to hear about. We talk about what's happening in the economy and the markets. And as always, we do question and answer. There's for those of you that have tuned in with us before, there's absolutely no questions off limits. On the lower side of your web screen there, you should see a chat button. If you have a question, type that in. It's completely anonymous, or you can let me know who's doing it. But there's absolutely no questions off limits, particularly because we're going to cover some stuff tonight that obviously you all think is important because we got a lot of you here that are joining us. You're going to see a couple other panelists that are going to join us tonight. I've got Kayla on here, who those of you that are clients know her very well. I've got George Irvin over from Fidelity will be joining me a little bit later as well to talk a little bit about what our relationship together is going to look like moving forward. And so with that, I'm going to dive into the agenda here that we've got tonight. So tonight's agenda is first, we're going to talk about why I think most of you are here tonight. I know that many of you do like to hear me opine about what I think is happening in the economy and the markets. But the big thing is this merger that we've got and this move from Raymond James with Fidelity as our primary custodian. That's where I want to spend most of the time tonight. I want to make sure that any of your questions are answered and you're very comfortable with this transition. If we have time, if we've answered a lot of these questions over the last few weeks that you might have about what this looks like, then we can go into some of the economic stuff, depending on how much time we spend talking about this merger. We can talk about the markets and specifically both in the equity market and the fixed income market. There's just some pretty cool correlations that you see with the overall money supply and why that's such a measure that why we look so closely at. And also for those of you that joined me back in January, I had two stories, both inflation and how the federal government's debt was going to be handled over the next 12 months that I thought were going to prove to be the two biggest financial stories of 2024. And again, this is all if we have time, depending on how much time we take on point number one here. We might dive into that a little bit as well. So with that, again, want to encourage anyone, any questions, nothing is off limits. We've got obviously Kayla, we have George and myself here. Hopefully we'll be able to answer them all for you. But let's dive right into it. So the big news, obviously, I think, again, why most of you have joined us is I want to introduce to you the team that we have, the Wealth Stewards, or TWS as we like to call it. So many of you got the email about a week or so ago that was discussing what this merger looked like, who some of the players were. But I wanted to give you an idea individually of who these people were that are going to be moving forward working with us, and also answer any questions that you might have about what their role is in this whole organization. So before I get into some of the details of the move, I just want to point out some of these people that you're looking at. So over on the far left-hand side here, you have Andrew. Andrew is much like a counterpart, I guess, to those of you that work with me. Kayla is very often in a lot of the client meetings with me, and she's obviously a huge resource that helps us out in serving our clients. Andrew's that position in many ways for Jeff. Next to him is Noelle, the young lady there. She helps also with some client services and also does a lot of marketing, and she'll be focused on a lot of those issues for us as well. We got a gentleman here, Chaz, in the background, who will be doing some behind the scenes IT for us. Next to him is Denise, real pivotal person moving forward as we build and develop this team. She's really going to be in charge of office operations. She's kind of our chief operating officer that's going to make sure that things are running correctly within the office. And she's also has a few clients that she takes care of herself. course, I'm flanked by my two people here that you've all come to know for the last several years. I've got Andy there to the left, at least in the picture, and Kayla to the right. That's coming that of course are going to be with us during this transition. Next to Kayla is Jeff. I'm going to tell you a lot more about him because how we got here, it's a pretty important story in terms of Jeff and my relationship together that got us to this point. Next to him is Ryan, who is another young man from Raymond James who's coming over with us. And then next to Ryan is Elena, who does some marketing efforts for us as well. So that's the entire team. One thing I'm going to just say ahead of time is that probably the number one question that we've got from clients is, will my service team change? Meaning all of a sudden, now that we are forming this new entity, if you were used to having Andy, used to having Kaylee, used to having myself work with you, will that change? The answer is no. There's just going to be a lot more happening behind the scenes. So we will still be your main point of contact. And so, don't have any concerns about what that's going to look like. And again, any questions? There's a lot of you here. I've got far more than we've ever had for any one of these before. So any questions, please ask. Nothing is off limits. So let's talk about, this merger and this move and some of the reasons behind it. First of all, who is this Jeff guy? And many of you have heard me talk about him in the past. And Jeff's a guy I've known for about 15 years, also currently at Raymond James. He's been with Raymond James for about 15 years. For me, it's been about 17 years at Raymond James. And so, as you can imagine, this move and what we're doing here was extremely well thought out for both of us. We've had very long-term relationships within the Raymond James family, and I do view it as a family. The relationship that we have had with our regional management team has been nothing short of exceptional. As they became aware of what our plans were moving forward, they have been more supportive. Obviously, they're not happy to see us go, but they've been more supportive on the back end to helping us do this correctly and efficiently than we ever could have hoped for. And Jeff and I, our relationship together again goes back for the last several years. We've been friends. For the last several years, we've also been each other's catastrophic succession. And so that was kind of the segue that got us into, learning a little bit more about each other's business and how we do what we do. And so what that means is catastrophic succession is if the proverbial truck ever came and took me out, Jeff would step in and take care of the clients, take care of the people that we work with. Vice versa, truck takes Jeff out, I would step in and be responsible for helping out with his office as well. And over the years of having that role for each other, which is a really critical one and one that we took very seriously, we got to know each other's businesses very well. And about a year or so ago, I'd say probably late springtime, early summer, we started playing with the idea of what would this look like? What would this look like if we merged our offices, we merged our teams together, and what would be some of the benefits from that? And as we began thinking about that, even at first glance, I figured we might be 85% aligned on what our goals for the business were. And I definitely had the sense that 1+1 was going to equal something far beyond 3. But we took it seriously enough that we hired a consultant. We spent several days with her. She met with all the members of our team to really figure out where everybody was going to fit in, how we can make this work as well as possible. And through the process of that, having that ability to sit down and think very deeply about the business, think very deeply about what we want to bring to clients, how we want to grow the business, how we want to expand our services, it became clear for a variety of reasons that the future for us was not going to be at Raymond James. And as I talk about some of these changes that we're making, again, none of this is a knock on Raymond James. It's been a wonderful place. I've been very happy here over the years. If you had asked me a year ago in April, would there be a move off Raymond James's platform, my answer would have been an emphatic no. But as we really started to think about what we felt the investment landscape looked like today, the ability to serve our clients the best, we felt that we had some other options that we could look at off Raymond James's platform, particularly in the independent RIA space. So we're going to talk a little bit more about that. But what that means is I'm already a CFP, of course, Kayla's a CFP. We are already acting in a fiduciary interest, but the broker dealer side of the business, without getting sort of too wonky and too into the weeds, it's kind of a sales channel. We've always operated in this sort of hybrid space, but we wanted to move truly into the independent RIA space, which would make the organization itself true fiduciaries. Now, part of being a true fiduciary is you have to make these decisions that you feel are the best interest of the clients. And being a true fiduciary, being in the RIA space, we have a choice of custodians. Now, in our case, we've chosen Fidelity to be our primary custodian. We have other options, by the way, and there are a few different assets that are going to be coming over that are going to have to be at some different locations. But this gives us a tremendous amount of power to look across the landscape and decide, hey, where's the best place that we feel our clients should have their money on? Who should be the best custodian? Who would be the best entity to hold these funds? And when it came down to Fidelity, a lot of the main reasons, and some of you have heard me share the story, but some of these will apply for some of you, some will apply for all of you. But technology is a really major thing. Some of our clients, looking at some of you that are in here right now, some of you don't care about the technology, and I get that. Some of you that I'm looking at the list of the people that are here right now, you really do care about the technology, and we get that as well. And I would say that if there was one, we'll just put as concern the clients had about Raymond James in the past, is they did not feel that the technology suite, the technology stack that they were able to plug into was up to the level of some of the other places that they had seen. Now, to give you an idea, Raymond James is a big firm. We've got about $1.3 trillion worth of assets. They spend a lot of money on technology. They're spending $600–700 million on technology. But looking at Fidelity and having the ability to tack into a company and now has $11 trillion in assets under management, they're spending $1 billion plus on just cybersecurity. So the ability for us to leverage their investment in the technology, both for what you're going to see as a client, also what we have the opportunity to plug into, just to me is a game changer. And as this technology piece becomes an increasingly important part of what we do, and I think we're at the front end of some of these applications in terms of how it's going to impact our clients and the business moving forward, we wanted to be at the place where we felt we were best poised to grow as technology brought a lot of changes, which we think are going to be massive to the industry over the next 5 or 10 years. Another piece, so many of you that I see that are in here tonight, you have done some lending with us. We do a lot of securities-based lending in here. It's a really important part of our business. Again, none of this is a knock on Raymond James. Raymond James Bank has been pretty competitive in that. But when we make this jump to the independent RIA space, we're going to have the ability to have multiple different lenders competing for this business. And for those of you, we have a few that have some outstanding securities-based loans that will be coming over with us. Goldman Sachs is going to be the lender on those. They're coming in about a percentage point better than what we could offer previously over Raymond James. So again, having that competition, I think in many ways breeds success. Having different players compete to help us bring you the best solutions, I think is a major benefit to our clients. Another one, alternative investments. This is an area that, again, for some of our clients, a really big part of what we do with them. For other clients, not that big of a deal. We've got about 29 individual alternative selections at Raymond James. Again, they're all very good. They're all very highly vetted. Not a knock on Raymond James, but moving to Fidelity as a primary platform, we're plugging into an ecosystem where literally the sky is the limit in terms of different options, different solutions on the alternative space that we have the opportunity to plug into. Finally, this is kind of an important one for me as well. I think that many publicly traded companies, and we invest in a lot of them, so it's not a knock on that system, but they're managing towards quarterly earnings. And I think in some cases that can maybe not lead to making some of those investments, such as technology, such as staffing, that you need to make in order to remain successful and remain competitive moving forward. Fidelity is a private company. It's owned by the Johnson family. It has been, I think, since 1946. I'm sure George is going to correct me on that. And they're not afraid to make some of those big investments and spend money in ways that I think is going to be very helpful. And finally, there's a lot of other cost efficiencies involved in this choice. As Fidelity again is our primary, not our only, but our primary custodian. And so with that, I want to introduce George Irvin. He's from Fidelity. He's been instrumental in helping us navigate this process, which we're getting very close to now. We're going to share with you some more timing and dates and things like that. But with that, George, I'll be quiet and let everyone hear what you have to say.
I really appreciate the invitation, Brent. Thanks a lot for having me. You actually nailed it on the date. 1946 is when we were founded, and you were talking about your dad. That's the year my mom was born, so I can always remember how old Fidelity is, which is pretty handy. Likewise, I think the things that you covered off are often the things that I'll start with when I'm talking to an advisor that's considering coming over. You and I have talked about them, and they're important to most advisors and hopefully a lot of clients as well. So outside of how delighted we are to have you join us here at Fidelity and completing your mission and servicing your clients, I don't think I have a lot more to add. We're just really excited to have you and your clients. I guess there is one thing I'll add. You talked about the breadth of Fidelity, and it's pretty wide. One of the things that I learned when I got here was that it's really hard for an advisor or for a client to outgrow Fidelity because we can do so much. One of the things that we've talked about with the Wealth Stewards is that a fair number of you out there have Fidelity 401k plans. What's going to be great is that Brent and Jeff and Kayla and the team if you give them this authority, in most cases, depending on what your plan says, they could be able to manage your 401k directly and at the very least see it so that you can get the benefit of them, not only with what you're doing here at Fidelity in your accounts, but in your 401k. So again, just another place where team can really hopefully add some value. Not to mention those of you that are business owners using some of our workplace investing where Brent is the leader on the solution, should be great. So outside of that, Brent, I think you covered all the great stuff that I want to cover with clients.
I'll add one thing I think is very interesting. I won't mention the name of this other company, but it's a company that we do on separate managed account side quite a bit of business with. And when I shared with him that we'd chosen you, and we had the option to choose them as well, by the way, as our primary custodian, he said to me, "I'm glad to hear you did that because in this particular company's case, the minimum that you had to be private client on their platform was 25 million. We don't have any of their alts available at Raymond James right now. Their entire suite of alternatives is available on Fidelity's platform, in many cases for lower minimums than they are in-house. And so it's the amount of scale that you guys bring to the business, I think is pretty incredible. And I will say this, George, I want to thank you from, as we've gotten to know each other over the last few months of doing this, you think large institution Fidelity, what kind of service are you going to have? And it's been absolutely tremendous in terms of the help that you have offered my team, the resources that you brought to us, brought to the table for us. So really want to thank you. And we'll keep George on for a little bit as long as we're in this merger piece. But again, I encourage anybody there's a lot of you in here. If you have any questions, for sure, please ask because we got we got one. Okay. I assume we have been investing in some form of a model portfolio from Raymond James. That's not necessarily true. I'll touch on that a little bit. Will our investments be shifted to a Fidelity model portfolio in the near term, over time, or not at all? That's a great question. Not the vast majority of the portfolios that we have built here, we have built them ourselves. We manage them through our own managed discretionary process. For some accounts, we will send them down to asset management over at Raymond James. That's about, to give you an idea, if the pie is $100, there's about $87 that's managed discretionary in our end. There's about $13 that goes down to Raymond James, just to put the math to it. So those portfolios, which is a small piece of what we do, that have been managed in Raymond James, still those securities will come over in kind. They will be managed, then they will move into our managed discretionary portfolios. Fidelity, to I guess clarify what our relationship is. So we will not be working for Fidelity. We will not be we won't be limited to any sort of Fidelity investment strategies or products. Fidelity is an institution that we've hired to act as custody of client funds. And obviously there's an enormous amount of bandwidth and research and benefits that we have through that partnership. But your accounts will not be managed by Fidelity. They will remain managed by our team here, and they will not be in Fidelity specific models at all, although we will have access to many more products through Fidelity. George, is that a fair assessment to that?
Yeah, that's a perfect descriptor. All Fidelity is doing here initially for Wealth Stewards is acting as a place for you to park your assets, for you to see what your clients have and tell your clients what they have through reporting and statements, 1099s, et cetera. And it's the place where you get direct access to the markets. So when Brent and Jeff and Kayla need a place to trade in your accounts, they do that through Fidelity. Now, one of the benefits of Fidelity is we have our own capital markets, but that gives us access to every market maker on the public securities that Brent was just discussing. So that's our role. We have an asset manager, and we'd love it if all of you decided that some Fidelity product makes sense in your models, but that's entirely up to Brent and Jeff and Kayla and the rest of the team.
Yeah, and there's no pressure or even there's no incentive for us to use a Fidelity product versus anything else. So another question. So you're acting independently of Raymond James and Fidelity. The answer to that is yes. And so one of the things through Raymond James' independent channel we've really enjoyed, one of the reasons we've been here for so long, is we have acted independently ourselves at Raymond James. We've never had any pressure from Raymond James to be, investing in specific investments, to do things this way. We've gotten, again, a lot of help and a lot of guidance from them over the years, but they have not directed how we've run our business and how we've chosen to invest client money. What I think is different is in many cases the solutions that we can offer on Fidelity's platform will be less expensive. And the other thing is they're going to be broader. I mentioned, for example, alternative investments, 29 unique solutions for high net worth investors, credit investors, over at Raymond James. The Fidelity platform is literally it's an open ocean. So what we're doing is we're going from a very beautiful walled garden at Raymond James, but it's still a walled garden, and we don't have as much capacity to step outside those gates out into a much broader world where I think the solutions that we can bring to clients really efficiently and really cost effectively are going to be far greater. And so we've always acted independently from Raymond James. That's why we are right now, at least until the 24th, and we'll talk about some dates. We are in their independent channel. We've never been in their branch system. We've always been their independent channel. This move with Fidelity as our primary custodians is going to give us a greater degree of independence. Great questions, though, guys. Please keep those coming because these are all extremely important. With that, I'll kind of pop over to the next slide to give you an idea of. Oh, we got another one. As we exit Raymond James and enter Fidelity, will both companies provide reports reflecting what investments we had at Raymond James and what open transfer Fidelity, and to confirm they all moved over? The answer to that is yes. And so there's a couple things here. Is first, you can access your accounts directly through Fidelity once they move. You will also be, we'll have some cases where we will have assets with multiple custodians. Again, 99% of them, at least from day one, is going to be over Fidelity. But we will have an overlay of that basically provides, links in real time with any of the other custodians that we choose. So we can generate the reports, through our platform, or they can come directly through Fidelity. George, anything you would add to that?
No, that covers it. When you transfer from Raymond James to Fidelity, we use an automated transfer portal. It's called ACAT, and that moves over not only your assets, but in most cases, the cost basis. And in 2020, well, actually, beginning of 2025, you'll get a 1099 from Raymond James for everything you've done with them up until April 24th, give or take, and then you'll get a 1099 from Fidelity. And the good news is that you can go to the Wealth Stewards portal to get that 1099, or get it yourself through fidelity.com. But you'll have more ways to get to that information than it sounds like you do now. But yeah, it's a direct transfer. You still have access to both.
Yeah, there's gonna be a couple of ways to access that account. Now, another question that we have in terms of the assets you have at Raymond James being transferred directly to Fidelity. We're going to touch on that a little bit in the next in a slide that we've got coming up here. One of the big ones that's kind of interesting is you think cash is pretty darn simple. That's one of the ones that's a little bit more challenging. So many of you have an enhanced savings plan over at Raymond James. It's yielding about 5%. That probably the end of this week will be moving into a JP Morgan money market fund. It's a money market fund. It will not break the buck. It's actually moving. It's yielding slightly higher. It's about 5.15, 5.17% right now. That will move to the JP Morgan fund. That will transfer over to Fidelity. Once we get at Fidelity, we're going to have other cash management options that'll be open up to us when we get over there. But for those that are holding large cash positions, that is one thing that you're going to see some changes initially. It'll come out of Raymond James Enhanced Savings. It's going to go into a JP Morgan money market as we transfer it over from that point. But that's a really good question. Another question we got: will there be any impact on fees? We hope that they eventually that they're better on the back end of this. Our fee will not change. The fee that we're charging clients when we make this move will not change. Some of the separately managed accounts that we do have, when we have outside managers, they will be, I would guess, at least as competitive over at Fidelity. They are stopped, well, as long as we're affiliated with Raymond James, they're actually not allowed on their end to tell us directly what their fees would be with Fidelity as a platform. But we're extremely confident that they're not going to be higher because of the scale and the buying power of Fidelity is just beyond anything that we bring to the table right now. So the fee structure initially should be unchanged, and we expect it's going to get better over time. These are great questions, though. Please keep them coming.
To add on that regarding fees as well, there are transfer out fees that are charged by Raymond James. So this is important to bring up. You will see them on your statement. All of the transfer out fees will be reimbursed. So you will also see the reimbursement on your statement as well.
Yeah, George, you want to speak a little bit about how that works?
Sure. So it's very common in the custody space and the broker dealer space to charge a client for the work that it takes when they pull their account out of that spot. So Raymond James is going to affect a fee in your account. It comes over as a debit position in most cases to Fidelity. And then Kayla works with our operations team to have that reimbursed generally on a weekly basis. So within a week or two of your account arriving, you'll have another item on your statement or on your transaction report that says a cat fee rebate in the amount of whatever that was. So that's the mechanics.
Yeah, so on the statement, what it's going to look like Raymond James took a little bit of money out of your pocket on one side and Fidelity put it back in on the other side. But great question. Great question. Keep those coming, please. Now, I want to give a really big shout out to these two, and obviously everyone that works with me knows both of them. The amount of work that they have been doing behind the scenes, along with the partners over at Fidelity and also Concurrent, we'll talk about a little bit, has been nothing short of extraordinary. So I really want to thank obviously both of them here, because what we're doing right now would not be possible were it not for all their help. Now, with that and those accolades, I'm going to put Kayla on the spot here, and Kayla's got a couple things that you want to make sure that we communicate to people. And so, Kayla, I'm going to hand it off to you for a second.
Yeah, absolutely. And I'm seeing a lot of these names. A lot of these people have already heard from me over the past few weeks, many times. But first off, one of the things that we are doing is, I'm sorry, my two girls got me sick. How dare them? So I'm still recovering. This has been the longest cold I think I've ever had. But we are sending out anyone who's taking monthly payments. We're just sending out extra funds. Once we get settled at Fidelity, as you can imagine, we're going to have a whole new system that we have to learn. We will also have to reestablish all of our periodic payments. And we are hoping to be very quick with all of this, but we don't want to have someone's monthly payment be missed. So you probably have received a call from me already. We're sending out a few extra months of payments this month. So that's the first thing I wanted to bring up. And the second is just, maybe I'm getting ahead of myself, Brent, but timeline. So the official date that we're resigning from Raymond James is April 24th. And I might get a little nuanced in this, but yes, Arizona, we have to switch our registration from Raymond James to our new firm, which is Concurrent. So Arizona is a manual registration state, meaning someone from the state of Arizona has to physically look at our request to switch our registration and approve it. So our transfer team is telling us it could take hopefully 2 days, maybe one is what we're hoping. So April 24th, April 25th, that's what we're expecting is our registration to be switching. April 26th, we're hoping that is the day that we can start sending out the transfer forms via DocuSign. The TWS forms at tws.finance is the email that the transfer forms will be coming from. We expect to call you when you can expect the forms. We're more than happy to walk you through it. If you have any questions, don't hesitate to call us. We do plan on being here that weekend. So April 26th, April 27th, April 28th. If you have any questions, call the office. I'm sure someone will be here to answer any questions. Once the Fidelity accounts are open, this is important, you guys can expect to receive an email from Fidelity. So after next Wednesday, if you receive an email from Fidelity, please don't delete it. Shortly after the account is open, you will receive an email asking if you would like e-delivery for statements. So if that is the case, you will click Affirm e-delivery on that email. After that, it will prompt you if you would like to set up a Fidelity account, which you are more than welcome to set that up. We are going to be using a more advanced portal to aggregate all of your accounts. It's going to be through an app called Black Diamond. So we will send you instructions on that soon after that to set up a Black Diamond portal to see all of your accounts together. But again, you are more than welcome to also have a Fidelity login.
Yeah, one thing I'll add to that. So you're really going to have in this independent world where we can choose custodians, there is going to be a couple cases where there will be a couple select assets, usually in the alternative side, that are either held directly with the fund itself, or at a different custodian because again, we're choosing what we think that the best option is. So what Black Diamond is in this RA space, it is essentially the software that allows us to really efficiently and effectively link everything up that is outside the primary custodian, which in our case will be Fidelity. So you can access either everything directly through Fidelity or aggregated via Black Diamond. It's going to get you the same information. To Kayla's point in terms of transition day, and we've got one question here real quick. It says, I assume the RMD provisions will still be enforced, remain the same. The answer is yes. The RMD provisions won't stop at all. In terms of the reason that we're unsure about April 25th is, Kayla mentioned this, but I'll reiterate it. Like some states, for example, you submit electronically, it immediately turns back on. We are a home state here in Arizona. Arizona is manual, which means there actually has to be a human being that kind of sifts through our stuff and approves it. We don't expect that to take more than a day to 2 days, but because you've got that human component at the state level, we just don't know exactly when that's going to be. We don't anticipate it would be anytime past the 26th. We're really hoping it's on the 25th. We've got everything that's kind of queued up for them, ready to go. But that's why there's just not that level of certainty in terms of what that's going to look like. Got a couple more questions here. So is it better to wait for Black Diamond? I think that's completely up to you as the client. Black Diamond, we're going to have the ability to do some pretty cool things within that platform. But if you also wanted to go on Fidelity and access it 2 different ways, you can do that as well. That's a great question, though.
I will say we are excited about Black Diamond. We actually saw some demos of it today, and it looks very cool. I automatically started thinking about some clients that are going to love it. However, we did learn that for statement delivery preferences, those changes are going to have to be made on Fidelity's website. So if you want to be able to change statement delivery preferences, you will have to have a Fidelity login. I will say that.
And we'll walk you through all of that. I think,
Yep.
many of the clients that we have, many of you are tech savvy. Some of you are still going to want to make sure that we're walking you through what it is that we're doing in terms of with all these documents and everything, and in terms of accessing the accounts through the technology we're going to bring to the table. We can help you out with that as well. Now, another piece is there's some special assets. We're going to touch on those a little bit. And again, it's not necessarily the stuff that you think. Annuities treated a little bit differently. 529 accounts treated a little bit differently. So if you have a variable annuity, you have a 529 account, there will be documents from a company called PKS, which is owned by Fidelity. But basically what that is these are broker-dealer assets that need to sit at a broker-dealer. PKS is going to be the person to house that. All be aggregated in. You will see it just like you do at Raymond James. So to give you an idea, right now, if you own a variable annuity with us, you see that on your Raymond James statement, even though the custodian of the asset, the person that has those assets is actually this insurance company. So those assets are not even sitting at Raymond James, but you see them on your statement. It's going to be very much the same way, where any of those insurance assets, 529 assets, they're treated a little bit differently than the pure independent RIA space. And so that's why some of you, not many of you, but some of you will see an additional set of forms as well. And I mentioned before on the alternative investment side, there's a few alternative investments that are just going to be a lot more efficient and a lot better to just hold those directly with the fund itself, as opposed to moving it over here as some cost savings by doing it that way, which is why we've chosen to do that. But all really good questions. We got another question coming in here. Says, I apologize if you already addressed this. Don't worry, because as George can attest to and is concurrent, which I'm going to talk about them in a little bit, I have probably asked these guys the same question about 50 times. So no issue with that. Says if one has a money market account where checks are used, do those accounts shift to another provider? So there will be a period where one should not write checks. Dynamite question. That is one that I'm going to flip over to Kayla because that's an important.
That's what I figured.
Yeah.
So yes, I would advise. So there's 2 different options, and if you want to email me or reach out to me separately, what we can do and what I've done for a few clients that regularly use either debit cards or checks or both is we are leaving the Raymond James account open for a little bit, especially if you have periodic payments coming out. It takes a while to get all of that switched over. If you still need, there's still some people needing to write checks for taxes. And so if you absolutely need to have the account open, you want to be able to write checks until we get your Fidelity checks issued, let me know. I will keep your RJ account open. I will keep cash in there. You can continue using it until you receive your either debit card or checks from Fidelity. And then at that point, reach out to me again, say, hey, I'm ready to transfer whatever cash is left in RJ, we can easily pull it over and close the RJ account.
Yeah, then that's a case where in most cases we're queuing this up so that existing banking relationships. That's why many of you, we've asked for voided checks. It's one thing that Fidelity's been slightly different with. When we in the past have linked an outside bank account to Raymond James, we could do it just with the routing number and the account number. Fidelity really likes to have the image of the voided check. I think it's an extra layer of security. Quite frankly, I like. I think it works well to do that. But that's why we've been requesting for many of those voided checks so that we can, as we're setting up these documents, the new account forms, we also want to have those banking relationships that are going to transfer over as well. But to Kayla's point, it is kind of Murphy's Law. Like I really feel very confident that this is going to be very smoothly. That noted, in the event that put it this way, the issues that can come with this transition are basically mismatch of information. Because what happens is Raymond James is part of something called an ACAT system. Fidelity is part of something called the ACAT system. Basically, what it means is if Fidelity goes and requests to have those assets transferred, Raymond James has 3 to 5 days to deliver those assets. It's just how it works. It's usually pretty seamless, unless there's a mismatch of any kind of client information. Now, if you're transferring over 5 or 10 accounts, obviously, you're going to catch a lot of. Hopefully, there's no errors if it's that small of a situation. But between Jeff and I mean, it's a lot of accounts that are coming over. We've been working on this for several months, and I'm highly confident that I think this thing is really good and ready to go. But in the event that there's anything that's delayed where we've got to go back and fix a piece of information or update a piece of information, I don't want anyone that needs to have funds and resources in their bank account to be waiting on us. And so that's why we've been told by some people, take the extra month. We really wanted to err on the side of caution for some clients specifically to take 2 months of distributions. That way we got plenty of time. Your life is not interrupted at all. We will take care of all this in the back end and get things done seamlessly. Now, I will also add to this because between Jeff and I, between our office, there's a lot of accounts that are moving over. And this is going to talk a little bit now to the infrastructure that we have behind the scenes. George is actually going to be out here and he'll have some people helping us out as well. And you've heard the name Concurrent. It's been mentioned in the emails that we've sent out to you as well. And I want to talk a little bit more about who they are and what that relationship is. So if you're moving into this RIA space, there's a lot of stuff that happens in the back office that you really want support for. And there are firms that do this, that work with independent teams like Jeff and I to provide an enormous amount of this back office support to basically act as the bridge to Fidelity, to act as the bridge to some of these outside managers to help us to bring to the table different solutions. And that is what Concurrent is. So what's interesting, and it's there is a Raymond James tie-in. So Concurrent at one point was part of Raymond James. We were operating within Raymond James, facilitating, again, independent teams that wanted to aggregate together for some of these services. They spun out back in 2022 outside of Raymond James. They're still down in Tampa. And what's at least to us feels very comfortable is I will still have a compliance officer. She will be a woman that was with Raymond James for 15 years before she jumped over to Concurrent, and I've known her again for a long time as well. There's a lot of really familiar faces with them, which is quite frankly one of the reasons that Jeff and I were aware that they were out there, that as we decided we wanted to move into this RIA space, we figured we could bring them in as a true partner to help us do it efficiently, effectively. And they're operating behind the scenes as well. They're going to have representatives and people out here helping Jeff's team in his office, my team in my office, respectively, to get this thing done. So Andy and Kayla have been doing obviously an enormous amount of heavy lifting with this, but we also have a lot of back support from both Concurrent and both Fidelity that again gives me a lot of confidence that this is going to be, I hope, very seamlessly. Again, Murphy's Law, there's always going to be things pop up that you're not considering, but I do think the amount of diligence, the amount of effort, and we've gotten a lot of feedback from Concurrent, from Fidelity. We've been planning for this for a lot longer than many other teams that have made this jump. And so whereas some people might try to get this thing done from deciding to do it to exit in 2 months, we made the decision that we were for sure going to do this back in December. And we've been all since that point really proactively trying to get everything together that we could to make this as seamless as possible. But any other questions about that before I talk a little bit about sort of the last point that I've got here on this slide? Okay. I'll add this. So another question that we're getting is, where's your office going to be? and contact information, things like that. I'll start first with the contact information. So, and this is kind of a big one, is our Raymond James emails will be, once we leave Raymond James on the 24th, they will not be usable anymore. So we're going to have new email addresses on the 25th. We'll be sending a lot of reminder emails out to you, but it's going to be basically our first dot last name. Right now it's Brent.Mekosh at Raymond James. It will be Brent.Mekosh at TWS.finance. That will be our new email address. The other question that we've had in terms of phone numbers is going to stay the same. That's going to map into our new organization. Another question is in terms of our office. You know, a lot of people, oddly enough, have never even set foot in our office here, but we're on 32nd and Camelback. That's going to remain the same until probably the middle or end of June. Jeff and his team are down in Chandler. Jeff and I, the big kind of news that we have is we're under contract to buy a building in McCormick Ranch in Scottsdale. We're hopefully we're kind of beyond all the diligence and everything, and so everything's pretty hard at this point. But we're looking to close around May the 6th. We've got our contractor hired. We've had probably a solid 6 weeks worth of TIs before we can get the teams in there. But at that point, we're going to get all the teams merged together under one roof, and that's going to be pretty much right by talking stick up there around McCormick Ranch for those of you that are local. And we've gotten a lot of people that we've told that to, particularly up in the North Scottsdale area, have been really positive about that because you're not going to be fighting some of this Camelback and Biltmore area traffic down here. But that's the other big piece that's going to be happening with us as well. But we really didn't want to. First, we didn't find a suitable place that we knew we wanted to buy until the time where this building came up. But also, we did not want to throw a move on top of this actual transition. So the transition is going to come first. We're going to have at least a month and a half or so post transition date before we even think about a move. All the dust should be settled from the transition at that point before we move offices. But phone numbers are going to stay the same. Many of you have my personal cell phone. That's going to remain the same. Emails will change. Kayla, anything else on that I missed?
Nope, that sounds good.
Okay. Any other questions on any of that stuff about the merger? Because we've been going now for about 40 minutes, so probably not going to necessarily dig into some market thoughts. I had this sort of in the back queue just in case the merger talk maybe took about 5 or 10 minutes. But I guess I'll add. I'll do a little bit of market stuff here and just some things that we're looking at, but then I'll keep going for maybe another 5 or 10 minutes or so. If you have questions specifically around the transition, around what this is going to look like, and again, we've got an email that's coming out tomorrow that's going to give you a lot more detail. Got an email that's coming out next week that's going to give you a lot more detail, but I want to make sure your questions are answered right now. All right, so let's take a look at really what's happening in the markets right now. So I'll just touch on this real quickly. You know, two really different markets. Stock market, a little volatility in the last couple of days, but been pretty good. The bond market kind of started off the year okay, has been a little bit challenging in the last couple of weeks or so. I'm going to kind of dig into that a little bit. And this is, I think, I've talked about this in sort of the last several quarterly reviews that I have. The biggest news to me in the last couple of years in terms of the financial world is not what happens in the stock market. People are used to volatility in the stock market. They're not used to this level of volatility that we've experienced in the bond market. And so this is a chart that many of you have seen. It should look fairly familiar. And again, please chime in with questions about the merger or this. Now that I'm going to get into this, but I'm going to go through this pretty quickly. This is basically looking at overall returns for the aggregate bond index. Think broadest measure of investment grade fixed income, high quality corporates, treasuries, and it shows you these red dots represent what the maximum drawdown was, and the solid bar represents where the market is either year to date today or where it closed. To give you an idea, in 2022, we came through a year where the aggregate bond index was down 13%. There's no one alive that saw double-digit losses in the aggregate bond index. 10-year treasury bond was down about 13, 14%. You had to go back to the birth of the country, post Articles of Confederation, to see all of a sudden double-digit losses in U.S. treasuries. U.S. government's been issuing debt for a really long time, never had a year like 2022. Last year was okay. We had a little bit of a rebound, aggregate bond index up about 6%, which is pretty good. But year to date, we're back in this kind of downward cycle. Interest rates have not really come in to the extent that people think. And you've got about 3% downside in the aggregate bond index. Now, those of you that have been through in reviews have had a lot of conversations over the last quarter. Our duration, our average maturity is so close to today that in most of our cases, we're either flat to up a tick in terms of overall performance in the bond market. And when I talk about duration, here's why. Because one of the things that I get from people that are coming into my office, they're saying, hey, you've got to add duration. All that means is they want me to buy more bonds that are maturing way out in the future. And we've opted not to do that for the last year and a half or so for a variety of reasons. But this, I just want to point out to you, here's why, because when I've shown you some of this on your statements, it may not have resonated. Let's just say interest are sitting here at 6%. Par value bond is a bond trading for, you got put $10,000, you get $10,000 worth of bonds that are yielding, in this case, 6%. Okay, a 2% increase in interest rates, if you're at a 10-year bond, a bond maturing 10 years from now, that's going to be a 13.5% loss in that bond. Three-year bond, it's a 5.2% loss in that bond. So that cuts both ways. Rates fall, you do better, but we're not quite, we're 4.5, 4.6% in the 10-year. That's historically super low. I'm just not in the mood to add any duration right now. And the other thing that we're looking at is, and this is really wise. This is going to tie into the next big piece that I've got. This is money supply, which is basically in the green here. U.S. cumulative government deficit, which is basically debt, is in the red. And this federal government is spending a lot of money. There's going to have to be more dollars that are thrown into the system to pay for that. Now, we're going to talk about the bond market a little bit more in terms of in a bit when we talk about inflation. Now we're talking about the stock market. I had to include this picture. I found this picture just so I was scrolling through some old pictures. Look at that young guy there. This is I'm 50 years old now. That guy was probably about 27 years old back when I was on the floor of the New York Stock Exchange. The thing I think is a riot with this picture is just look at all the male pattern baldness that we're looking at. But in any
That's
event,
you, Brent?
that's me. Yeah, that's me there on the right hand side. But yeah, I came across that picture. I figured I had to throw it in there. But let's talk a little bit about the stock market, because this was my world for a very long time before I got into this side of the business. One of the other things that we've talked about, I'm going to touch on this really, really briefly, is how heavily concentrated the S&P 500 is right now in a couple key big giant names. And when I talk about some things being historic, what's happening in the bond market is historic. Also, what's happening in the stock market is historic the other way. This in the upper right-hand side, this is the weight of the top 10 stocks in the S&P 500. So basically 34.6%, let's just call it 35% of the S&P 500 is 10 stocks. So if you remove those 10 stocks, it basically 65% is the other 490 stocks that are out there. This is a historic weighting. Most of them are big tech. We just have never really seen that before. But at the same time, those companies are contributing less to earnings than their actual weighting. So they're making money. These are highly profitable companies, but they're also really expensive. Now, the last time we saw something like this was back around the dot-com in 1998, 1999. This green is basically imagine as this goes up, these stocks are really expensive. So when you see this peak here, these big stocks that represent a big chunk of the S&P 500 are very expensive. Things normalized till about 2018. These big stocks are really expensive again. So a lot of these names that we own a lot of them. Microsoft, Apple. If you look at or Alphabet rather, these are stocks that exist in many of our portfolios. But we don't want to be at the same weighting as the overall S&P 500, and that's something we're pretty comfortable about. Just because these stocks, grant, a lot of the returns that we've had over the last year and a half, which have been great, have been generated from those stocks. But you just got to kind of tread lightly there. The other thing I want to talk about money supply real briefly as well is, a question I get a lot is looking at what our deficit situation looks like is, people get a little bit spooked in terms of the overall stock market, but that debt and the money supply has been rising in tandem for a long, long time now. But if you look at what the money supply is doing, the S&P 500 is roughly correlated with increases in money supply. So it's a really good defensive hedge against what the federal government is doing in terms of printing and spending a lot of money. Got some more questions that came in. I apologize if you already addressed this. If one has a money market account where checks are used, do those accounts shift to another provider? So there'll be a period where we should not write checks.
Brent, we already addressed that question.
Okay. One says, thank you, my pleasure. Another person says, great presentation, confident you got this. I appreciate that as well.
Appreciate the confidence in us.
Appreciate the confidence in that as well. I'm going to touch really briefly on these two big stories that I looked at in Q1 that I said we're going to drive the financial landscape this year. One is government debt and spending. I mean, this is the one that if there's things that keep me up at night, this is probably one of them. I mean, this is right now our structural deficit. Left-hand side here, all you really need to see is that, we're looking at borrowing 1.5, $1.6 trillion in excess of what the government is bringing in. You just got to watch this here. I mean, if you're looking at the lower right-hand side, federal net debt, there's accumulated deficits. I mean, we're at levels we haven't seen since World War II. But at the tail end of that, we just got finished fighting a major war. And I think this is the one thing that I look at. It's not a problem, I don't think, a year, 2 years down the road, but it's something how this gets reconciled either in some control on spending or rates going higher because the federal government is issuing so much new debt. I think that's going to be the financial story of the next couple of years is how this all gets reconciled. And this headlines are saying the same thing. I mentioned $1.6 trillion deficit. from the federal government this year. They've actually increased it by 1.1 trillion over the last 6 months. That's coming from the Wall Street Journal. And this federal debt held by public, again, we're at this really key inflection point where if they don't make some really serious structural changes, I mean, we're in kind of uncharted territory. So if there's one thing that kind of concerns me moving forward, it's really what our federal government's doing. And to this point, another Wall Street Journal article, it says America's bonds are getting harder to sell. That's true. That's why you're seeing rates tick up a little bit, particularly in the longer end of the curve, which is again why when we're investing in bonds, fixed income, we're just not buying bonds that are maturing out 10 years. We're keeping 1, 2, 3 years out. And that's really one of the main reasons around that. It's monetary base. Again, I mentioned the S&P 500 kind of roughly correlated with that over the past. We had the monetary base rolled over in 2022. You saw stocks roll over. Well, it's turning up again, and we've seen stocks kind of turn up again with it. So that's just something I wanted to point out as well. And those are just some different things that we're looking at. So with that, I'm going to go ahead and jump to Q&A. I'm going to jump past this because I've kept you for almost an hour. Any other questions? I know I kind of ran through some of those financial slides because the primary reason that we got together today was to answer questions you might have about the merger and obviously the move over to Fidelity. But any other questions while we've got George is kind enough to join us from Fidelity and Kayla and myself here. If there's anything you don't want to ask, then please feel free to message me offline. But I'll give it another couple minutes. And with that, I just want to say to everybody, I kept you for 50 minutes. I really, really appreciate it. I'll close with this, one of the most really gratifying things over the last, 3 months or so as I've been out at least telling this story initially with what we're going to be doing with Jeff has been really, sharing this plan with you and the fact that you all are so optimistic about taking this journey with us. And one of the great things that I love about this job is I'm able to walk with you on your journeys and doing all the wonderful things that you're doing in your life. And the fact that now that you guys will be joining Jeff and I and now this expanded team on this journey, to me is just incredibly meaningful to me. So I want to thank you all from the bottom of my heart. Got one more comment. Says, what a team. So glad to be a client. Cheers from down in Florida. Yeah, I think it's an amazing team. And I'll close with this. You really find out about people and how they're going to respond to things when the pressure is on. And I will say that with Andy and Kayla and Jeff and his entire team down there, the pressure has absolutely 100% been on over the last 2 or 3 months, and the degree that everyone has just shown up and worked together to move this ball forward, to me has been absolutely inspiring. And I'll close it with that. I've never been more excited about the business that I am in. I've never been more excited about the solution set, the services, and our ability to grow and expand with you, our clients. I'm just fired up to make this thing happen. And it's here. It started as sort of this abstract idea that Jeff and I had about a year ago. It got a little more concrete into the fall. We had a real clear vision of where we wanted to go by December, and now it's here. It's here next week, and it goes to show that first you can accomplish more in 1 year than you thought you could, and secondly, the time goes fast and it gets here a lot faster than you ever could have imagined. So with that, if I missed anything, if anybody didn't want to ask any other questions, I want to thank you all for being here. George, thank you so much. I know you were super busy. It means a lot to me that you carved some time out to do this with me, and Kayla and Andy, who I know are here listening. Thank you, and most of all to our clients that always are on this journey with us and that always join me for these quarterly reviews. Thank you guys as well.
And if any of the clients have any questions about your particular investments, or if you have a 529, as Brent mentioned, 529s are a different, they're not DocuSign eligible. So if you have any questions about specifically what you have, please reach out to me. Or if you're still using checks or debit cards, reach out to me, make sure we leave the account open. I'm happy to answer any questions like that. And us and the team we're actually having a team dinner together this Friday to celebrate and prepare for next week. So we'll be here for you guys to answer any questions.
And Tom, thank you. And it's great to see you watch you grow. And with that, it is great to see things grow. So thank you, everybody. And if you have any questions, please reach out to any of us offline. And that is it. I guess.
Choosing us. We're delighted to be working with all of you. Talk to you soon.
Thank you, George. We'll see everybody.